Hello YouTube. The S&P and the stock market are going to be facing their final boss with Jerome Powell this week when we try to do something we have not done in 14 years. I am talking about interest rates going up. Right now, the only time we have actually seen that period of higher interest rates with higher highs is from the 1950s through to the 1980s. Since then, or before I was born in 1980, we've only seen lower highs. So now, as we get really close here, that's what we have to deal with right now. Jerome Powell is the final boss, and the stock market right now is at a pivotal point. Why? Well, we're losing the green line, which is the uptrend. We have dominating red volume ever since the all-time high. We only have bearish engulfing candles. Every volume bar is followed by a smaller green one. People are more excited to sell than they are to buy. We are respecting our downtrend. We are losing our uptrend. And we have a bearish engulfing candle. That is a big deal, and I will get to that a little bit later in the show. But at a very high level, that is what we have to deal with this week. It's really what Jerome decides to do. There is honestly a lot of information to go through. What I've decided to do is to try to condense all of it into what matters for this week. As we look at our key dates, as we look at our why bull or bear, and as we go through something new, please drop me a comment and tell me what you think. It is my notes where I prepare my fundamental, technical, and psychological current review. We're also going to review our bear market targets and a little bit of evidence here that maybe we are repeating 2008. But I don't want to ring the alarm bell. I would rather focus on letting Jerome allow himself to speak for himself, and then we will react to it. Instead of trying to predict what he will do, we will look at what his tools are. He only has three with his words. But his two tools he can do to actually affect things are going to be the interest rate and printing money. And right now we are looking at a dual-edged sword where he's going to be hitting us with higher interest rates. We're going to be printing more money. We're already set to do a higher high. And now the question is, how high? Back to 2018, 2005, 2000? Where are we going to peak out? Where's the terminal rate going to be? So as we start to tell the story here, I want to focus on try to make it as simple as possible, what Jerome has to do. And if you're interested, please click on the link in the description if you want to find out more about our group, where you can join us and go pro, which means you can be part of our trading community, where I've laid out everything in detail. But I really want to focus on my high-level notes because I think this is the easiest thing for us to try to just understand. We're going to talk about the fish swimming upstream in a moment, but just to get through a little bit more of the data, these are the two things they can do. So on Wednesday, when the Fed meets, we go back here to our date. We got Wednesday as the FOMC press conference when Jerome speaks. We also have him coming in on Friday, but more importantly, it's going to be the first event on Wednesday at 2 p.m., the Fed interest rate and the SEP. So we'll look at the charts a little bit later to look at whether or not we're seeing technical confirmation of that move lower. But right now, these are the two things that can happen. We're gonna talk about interest rates, and we will also talk about printing money. So when we talk about the Fed balance sheet or the printing money side, either printing or removing, when the orange line or the Fed's balance sheet goes down or flat, the market goes what? Flat or down. When we reduce, the market goes down. So what are they telling you? We're gonna do twice as much quantitative tightening as we've done since the last cycle, which means they're gonna do twice as much as this. Oh, goodness. Low, lower, lower, lowest? Interesting. Yeah, that's interesting. So we have to keep that in mind. The first tool, they're planning on not printing. They're planning on removing. That would be quite bad. The relationship here is very easy to understand if we just look at the S&P or the blue line versus the orange line. Really simple. And now we look at the second lever, which is interest rates. So we look at Powell is looking well past the next inflation report. And the reason why is because, I need to bring it back up. I think I closed it. It comes to the inflation story because what Paul Volcker had to do in the 1980s was raise interest rates, lower them. And let me actually pull up the image here because it actually tells a better story than I can. So when we look here, we go back to our inflation story. And just to make it really simple, I'm just going to show one graph here. What Jerome has said is that we're going to go higher for longer. So inside of this period here, we start forming higher highs. And then we go from 17% interest down to 9, only to form a higher high. And what Jerome said is that I have learned from the previous Volcker era, someone who I think is I think he said a role model. That's important. And we want to ask ourselves, okay, so if Jerome is saying that I've learned from Paul Volcker, and Paul Volcker made a pretty big pivot here from 17 down to 9 back up to 18. When Jerome says higher for longer, what he's saying is that we want to avoid this period right here where, we should have actually just held it a little bit longer. Incoming data came in soft, which just means that we saw bad data. And when we say bad data is good data, good data is bad data, well, that's what happened. They pivoted too soon. It was not a trend. And that's what Jerome wants to avoid. He wants to avoid that. So when we look here at, this is called the dot plot. So when we look at the dots, which mean where do the median Fed people think we're going to have our interest rates, what we want to think about here are the times when we have our quarterly meeting. Why? Well, because we're coming into a quarterly meeting. They happen in December, March, June, and September. So we're going to focus in here on 3 different lines, all dotted. We got the orange for December, red for March, and blue for June. As we look at these numbers, what it tells us is that the market had its nastiest cuts back in December. Why? Well, let's look at what the interest rate was doing. Okay, up, up, up. So in December, we were pricing in stocks should go down, down, down. Again, they're inversely correlated. This line goes up, stocks should go down. In March, we start pricing in a Fed pivot or a pause. Sorry, why? Up. We're going to go up, up, flat. Oh, we're kind of peaking out. Yep. And then when the market had its relief and started forming higher highs in June, it was all predicated on up, up, down. Nice, right? A reversal, a soft landing, whoop. And now we're realizing that that's probably not going to happen. We need to do this. If we delete these lines now, that's what happened. And the market does the inverse. And that's only about 2%. Right now, inflation's at like 7%. So this is what the Fed's going to have to actually do, right? Up over 4 before the end of the year. And then at least for right now, that's going to be the September line. Let's pretend this one's pink here, right? Pink line for September 2022. And that's what this is probably going to have to look like. And flat. We want to avoid that same thing that Paul Volcker did earlier. So that's really what I'm going to focus on. We will get a new screenshot. We will get a new dot plot. We will hear about the quantitative tightening. We will hear about the summary of economic projections. So instead of trying to be like, well, this is what the Fed's going to do. We do exactly this, blah, blah, blah. I think let's just Jerome speak for himself. We understand his 2 tools. I've tried to explain a very complicated subject matter in a very short amount of time. So if you have comments, again, please smash a thumbs up, drop me a comment, and tell me what you think. I would love to read your comment. Please and thank you. And yeah, Jerome's probably a little puckered up because honestly, this is a really tough position right now. I think that he's going to do what he thinks is best. And with all things said and done, we don't want to fight the Fed, which means we don't really want to be those fish swimming upstream. That's what this looks at here. So just 2 more things to look at before we start moving forward. Okay, so normally any time of year, September bad, October good. So if, again, thinking about if Jerome does actually tell us what we want to hear, meaning bulls for the stock market want to hear about the pivot, the pause, just not more up. How much more up, right? Oh my goodness. That's what we don't want to hear. So normally and seasonally, September is the worst month of the year. So no surprise, we have our worst day since 2020. When? This week in September, the worst month of the year. Surprise, surprise. And we went into the reason for the option motivation going into Friday, which is 3.2 trillion. And just as a reminder, the one-day wipeout that we had on Tuesday was 1.6 trillion. So when we look here to our one-day chart, as dramatic as this move was from Monday close to Tuesday open, Tuesday close to 24 hours, that was 1.6 trillion deleted from the high that we set at about 411 down to the next day in our close at 393. So 2 times as much expired in terms of options on Friday. So what will happen post-expiry? Well, normally we get an opposite move of the true move. If by closing at the low of the week, we have what? Continuation to the downside, that would mean that we really have to pay attention to 380. And if we get relief, we want to be mindful of what that means. It's that simple. So worst month of the year, one of the worst days. Oh, surprise, surprise. Yeah, selling may and go away and come back on Labor Day. So what's really important here is looking at whether or not bulls are swimming upstream and whether they are currently in a hard penny environment. A much more eloquently stated way by Mark Minervini here is, why fight for pennies? Let's just zoom in here to make sure we can actually read it. I think you guys will appreciate this. Why fight for pennies when you can simply wait for easy dollars? You must learn to distinguish the difference between easy dollar and hard penny environments. I only get aggressive during easy dollar markets. We are now in a hard penny environment. You can fight for pennies if you want. I prefer easy dollars. Mark Minervini. I agree with that. Easy to say, hard to do, especially when you do daily videos and weekly videos. There's a lot of noise out there. But we want to make sure that if we're going to go bold, make sure we understand. It's okay to take shots, but we are fish swimming upstream. It's not that the fight is not worthy. It's not notable. It's just, well, what's the goal? What's our ROI? And are we better off just waiting around in the lower pond and waiting until the conditions are better to actually jump up? It's that simple. We've heard the cries about -20. I'm not going to beat that horse. If we get the negative follow through next week, I will do a bear market update. But for now, we're just going to focus on what it could actually mean for this current week. So Scott Miner, as I said before, like last weekend, said -20 by mid-October. So if you're getting a warning right now that we could go down by -20 between now and October, if you hear the warning and don't do anything, fine. That's up to you. If you hear it and want to protect yourself, yes, buy the fire insurance. Maybe even as there is a fire happening, but it's not in your town yet. The S&P is on fire, right? Its hair is on fire. It's a matter of whether or not it's going to start spreading lower. We got 360, 370, 380 as weekly higher lows progressively. So 362, 371, 382. If we lose 380 or we lose that IHS neck, 370 is inevitable, 360 probably, and then probably even lower. So instead of trying to fight it, let's just be mindful of it. Which means, yeah, the month is not over. We're about halfway through, and this is normally the worst month of the year. Oh, no. All right, cool. We understand that. And if we understand that, if we're hearing that targets could take us down to -40 off the all-time high, if you've lost less than 2/3 of your money, you can make it back. But you gotta buy the right dip. And that's where my new thing that I have here for my Justin Notes tells us that the easy dollar environment from a technical perspective is just being short. That's what our algo says. And until S&P can print a higher weekly high, I am not putting on any new fresh investments. That's a hard penny environment. So I'm going to take a note from Mark Minervini, because even myself, by doing the daily videos, I find myself wanting to make trades based on hourly or daily timeframes. I keep saying, well, we kind of cooled off. Maybe it's time for the next big rally. I should nibble along here. I should take a shot. And at a certain point, I would prefer to only be on the battlefield when there are easy dollars up for grabs. Right now, it is a hard penny environment. It is hard out there, as you probably know. All right. Okay, so in about 13 minutes, I think I've done an excellent job compared to previous weekend videos to lay the foundation for what I think is a really important week. Now I'm going to start going through my notes here. We're going to look at a few charts, and then we're going to probably leave it there. I'm looking for no more than 30 minutes. And drop me a comment and tell me what you think so far. Do you like it? Do you not like it? Do you agree? Do you disagree? I don't think it really matters. Just tell me what you think. So what we're going to look at now is going to be the options chain, because I've kind of laid out what I think is going to happen here. Let's look at October. So we look here to October, and we note that, there's not really... First thing I note, and this will be the pattern here, we're looking at only monthly chains, because we're looking at a multi-month time horizon going into Q3 and beyond. There's not a lot of call activity in terms of open interest or volume. On the put side, only looking at the 16s for what is probable. We got 390, 385, and 380 as levels of interest. Read the numbers if you want. I don't want to scare you. Looking at the next monthly expiry in November, what do we have? Exact same pattern. Lack of call vol or OI. And on the put side, we got open interest at 390, 385, and 380. What's the premium on this? At the money. It's about $14. So that means that we got to be at 370 in, let's actually go back to the one in the next month. So before we even look at the VIX, what we can understand with SPY where it currently is, SPY right now is at 385. So a 385 put for the next 36 days, meaning the monthly October chain costs $10. 385 minus 10 equals 375. Basically barely hanging on to our July low. So that's really important. If we now go further out, now that we understand there is open interest, that's the level we have to hit for these guys to get their money back, not to make anything, to get their money back. And because there was volume starting in October for that monthly, we're seeing continuation. We would assume a lot of people are looking in the same direction. Here, same thing. We now see we got 390 to 380 here. And for a 385, these are now worth $15. So in 2 months, the insurance for the S&P is now telling us a 370 break even. Remember that number we just talked about? 372, 371, 372. All right, now let's look to December. Oh my goodness, exact same thing. OY at roughly 40K at all those same strikes. 390, 385, 380. And now with 380 put costs us $17.50. Yeah, that means we're pretty much going down to a low of the year before when? Before the end of the year. That's what the premium implies. Is that what's going to happen? It's insurance. We don't know. VIX is not even really elevated right now. And then final one here. There is now finally some open interest into the calls at 420 for January 2023 or a leap. And everything else is still pretty bearish. Premium's much higher on the put side as well, so got to give it to the bears. There we go. Jerome, right? Man, I don't envy this guy right now. Over at the ECB, ECB's lane sees several more interest rates increases ahead. So the higher for longer, when we think about the interest rates we just talked about, it means that if we're not fighting the Fed and they're going to go up, man, we should be prepared for more downside. Absolutely. There we go. Key dates. So what's really important this week is that we have less events. We got 4, but they're all red, except for 1. So those are really important this week. We have less to focus on, but what is said will be more important. On Wednesday at 2 and 2:30, we'll hear from the Fed. Instead of telling you what I think Jerome will do, let's listen to what he says and let's react. I'm not putting the, oh my God, it's 2008 again. That will be next week. If what I think happens, I will talk about that next week. Until then, let's just wait and then we'll react. Jerome Powell will have a chance to rectify or fix or clarify anything that was said on Wednesday that maybe was misinterpreted. At the previous meeting, what I noticed is that he had the prepared remarks, which said that we are not at neutral. And then during the Q&A, he said basically, we're at neutral. So if we are or not at neutral is not what he wanted the market to hear. He wanted the market to hear what was in his prepared remarks. We are not at neutral. He wanted optionality. So because it's a quarterly meeting and the stakes are high, if he miscommunicates on Wednesday, he has a chance on Friday to clarify. And that'll be particularly important for me. Because when we think about what he has to really do, he has to toe a very close line where people have said like he's walking on a high wire, like we're playing like he's in the circus when they're on the high wire. That's what it's called, the high wire. He is trying to not fall, and he's juggling, right? He's not only on the high wire, he's trying to juggle. Now he's having things thrown at him. This is like a really tough job. I don't know. Instead of trying to tell him, let's see what happens on Wednesday. Let's see if we get the confirmation. And why does this matter? It matters because on Friday is when we get our weekly close. And after this pattern, if we are red in the week, we have more confirmation we are in a bear market. It is that simple. Friday at 2 is really close to Friday at 4. We will be on again next Friday to take you through the last 10 minutes for the S&P if you want to tune in for that. Looking at the why bull or bear, without all of the minutia or details, 3 out of 4 for the bull case are scratched out. What does that mean? There's still a bull case, but it's shallow. It's not looking all that strong on the bear side. We got the 50 weekly moving average rejection. Check. Starting to repeat 2008. Absolutely. DNX, TXY breakouts. Yes. A 454 unpenetrable fortress. So far. Deep global recession risks. It appears that way. Tara? Not really. Europe kind of doesn't look all that good. China's back to easing, but I personally would not invest in China. That's just me. So if we think about what would be the surprises for this week, I think the dot plot, which we went through already, those were those dots that we looked at, the dotted lines. The balance sheet, which we went through as well. The SEP, which is the summary of economic projections, or what the Fed thinks is happening in the economy. Powell speaks twice. And then earnings season, where there's already a pretty sour note from FedEx in regards to them pulling their guidance and saying that the global outlook looks pretty bleak. The world looks pretty bad. That's what they basically said. So if we take all that together and we look here at the notes now, I want to try to explain this in as few words as possible, but to make sure that we understand how much work went into this. So I'm now recording this like pretty late compared to when I normally publish these things, and that's because there was a lot to go through. I don't always know what I'm going to find when I start looking through on Saturday. But when I get to the end and I'm before I hit record, it's either short or it's not. And because when I made the original video in January for the bear market of 2022, well, like our all-time high is Jan 3. So every 3 months, or here, and then in March, which is when we have our last Fed meeting. Oh my God, that's like the last top. Yeah. So January meeting, our March meeting, and then our June meeting. Whoa, that's like perfectly when the market moved. Yeah. Whoa. Right? Oh my goodness. January. Yeah, that's like we talked about that. March. That was the another top. And then June. Yes. So the video you clicked on said the stage is set. And maybe because I've had to re-record. They came in and did some cleaning here and I got really disturbed when I was recording. But anyway, if we look here at the stage is set. Yes, the stage is set because if we keep going lower, we're probably going like a lot lower. If we get a pivot, doesn't matter what it is. If we get a pivot, we gotta pretty much print higher highs. Otherwise, it's not looking all that good right now. There is a lot of work to do, and the stage is set because we're so close to just not really needing that much more evidence for us to go down. I'm having a hard time remember like what I've already said and what I haven't said. So we're now gonna just go through because it's been 22 minutes. Trying to think about what would be the most value here. Bear market targets. Let's get this finished off. I think I already showed the Goldman Sachs thing, I think. So I'm looking for as low as 336, roughly 340. Target's been confirmed by Goldman Sachs. Cool. I was going to show this thing, I think. Okay. So briefly, so look at this chart. What I'm looking at here are, first of all, the pattern. We have a head and shoulders. We have a parallel channel. We have a green support line. This is 2022. This is 2008. We look at the volume profile, same. We got bigger red bars than green. We got the channel. We got the head and shoulders. We got the two arrows where we lost the 50 once and then lost it twice. Here's 2022. We're just starting. So far, it looks so similar. Everyone's showing the line chart. I like looking at it like this. And what's more important for me is I'm looking at the engulfing candles, because an engulfing candle for me means that the other team or the opposing team not only was losing, but then massively won compared to how things were priced going into that. And what I mean is when we have a bearish engulfing candle, it means that at one point during the week, we had a higher high, and then we didn't. We closed with a weekly lower low, and we closed lower than we were at the previous low, which means that that's a trap. So, a trap. Yes, that's what a trap is. In 2008, we had one bear, one bull, one bear, one bear, and then we had the big massive drop. You can see those here with the red and green boxes. So since the all-time high, we have red, green, red, red. Okay. Then we look over here to 2022. Sorry, we had one bear, one bull, two bear. And now in 2022, we got 3 bear in a row, 1 bull, and then 1 bear, which shows us here that we actually even have one from before. We have the one before the all-time high, but from all-time high, we got 1, 2, 3 red in a row, which are red engulfing. And then last week, we have a bull engulfing. And then this week, we have a bear engulfing. Yeah, that's like a double trap. So Who has the better mousetrap? Is it the bears or the bulls? Who cares if it's options motivated? Who cares if it's OPEX? Who cares if it's the Fed? A bearish chart is a bearish chart. And if we're trying to make money, our goal is to make sure that we are just receptive to what is happening, not what we want to see happening. So the parallels are definitely here. If we repeat more, I will dive more into this next week, where I will give the bear market update if we're there. If not, why do we need to scare people? All right. Key dates, talked about all those, all done. Why bull or bear? I think I said it. The bear case is still there. It's just 25%. Bear case, 80%. Okay, looks like red team's winning. Yep. Surprises, dot plot, balance sheet, SCP. Earnings. Yep, I think all those are out. Okay, now I'm going to explain my adjustment notes. I'm not sure if I've done this again. I'm going to go through, just read them fast, and I'll see if I need any supporting evidence. It's at 26 minutes here, and then I will just look at a couple of charts and then sign off. Higher highs on interest when global debt and economy cannot handle what's needed to get us to 2%. That doesn't make sense to you? Just ignore it. It means that I'm watching what Jerome's going to say. I want him to basically say we're not anchored at 2%. So far, he said we're committed to that. Which means that they got a lot to get down to 2. They need a new mandate, or something's going to break. I have all the evidence on Slack. Again, click on the link in the description or the top comment if you want to join us to go pro, to trade with Justin and learn about how I put all this together. Fed plans to use both tools, interest rates and the balance sheet, which I just said. Both tools were not used in 2000 or 2008. Oh crap. 2000 and 2008 were just one sector, one country, which was housing and then technology in the U.S. and also the mortgage collapse as well. What's the Fed selling? Mortgage-backed securities this time. Oh, what could go wrong? Oh, never seen this movie before. So in 2022, now it is every sector, every country that is impacted in 2020 to 2022. This is a global crisis. And then there's also the geopolitical risk, which I think is a little bit more elevated in the short and medium term. The TA, 2008 and 2022, there are parallels. I've just shown them to you briefly. If there's more evidence, we'll follow up on that next week. Our algo says to invest being short, which is the inverse alerts we've looked at, SH, DOG, RWM, DXY, TNX. And from looking at the, let's go back to here. So let me go back to my notes. In 2008, ever since we had our reject off the 50 weekly with that bearish engulfing, there was a pretty nice reversal week here. So that's why I'm going to look at two things here. I'm going to look at, okay, so bearish engulfing after the bullish engulfing. So we got our bullish engulfing, then the bear one. Ever since that happened, we did not have a higher high. So regardless of whether or not we get a green week or a red week next week, I'm not smart enough to know. But as the notes say here, if we're going to have a easy dollar environment, first of all, we have to be going up. We're not going to go up if we're forming lower highs. So there's our bullish engulfing, bearish engulfing. This is 2008. And then ever since we have that bearish engulfing, high, lower 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 high. And every single time it was lower high until we formed the higher high here. And that is after we went down 27%. And that gets us to 350. 350 on SPY is what? That is our current 200 weekly and our 50 monthly, which are from our bear market targets here. I already closed the tab, but that's our blue line on the monthly and our gray line on the weekly. Ah, math. Yeah, we've gone through the math stuff before. So the easiest way to think about this is that unless S&P can print a higher weekly high, there are no long investment positions for me, personally. And I've caught myself saying this twice. Just have to cool off for the next big rally. You've seen the psychology charts. To make it really simple, we've already read the quote as well. And I'm finding myself wanting to make trades or swing trades when I should be focusing on the investment horizon. I don't want to be that fish swimming upstream. So I believe that is everything I needed to do, and I'm just going to do a few more minutes to go through a few key charts, and then it is time to sign off. So if the most important thing right now is SPY on the weekly chart, what we're going to want to look at is going to be just the things that are going to tell us whether or not there is evidence that is strong or weak for this. QQQ. Let me actually, I think this is the wrong chart here. So SPY, we're throttling that -20, which is the bear market territory. We got our support and resistance levels here. Pause the video if you want to read them. If not, I'll move forward. We got QQQ. So QQQ, or the Qs, are fighting for roughly -30 when S&P is fighting for -20. That is its IHS area at 279. Really, really important. DXY, without jumping in too deep, we got a golden cross and we got a record weekly multi-decade high. That is going to be the pattern as we go through to these next charts. That's right. This price on a closing basis has not been seen going all the way back to 2002. That is a multi-decade high. VIX over 25, which means a roughly 1.25% daily move, just as a reminder. Looking at the US now, we got a multi-decade high going all the way back to 2007. 2007, that's like around 2008, right? Weird. Okay, cool. To a 10-year note, multi-decade highs, not seen since 2011. 11-year highs, inversion. Yes, sir. What do we got? Oh, we got an all-time high. Never seen this weekly closing price. Oh, actually we did. Sorry, my apologies. Golden cross. But here on a weekly close, this is the third strongest weekly closing for inversion ever since it's been tracked. And then since we are really focusing on whether or not the last soldiers are going to be breaking down, we also note that Apple here has a really, really nice clean pattern for us to read. It is a inverse head and shoulders. Same thing as QQQ and SPY. And this level here is going to be really close to where we are now. So if we lose roughly 150, really easy number to remember, which is where we are now. We already poked below it. This is starting to break down, and we're already in the supply zone. Apple's a really strong, fantastic, terrific company. One of my faves. Is it going to be the only stock to survive in this market? I don't think so. Tesla also looks really strong, which we'll look at in a moment. But we're just going to look at Apple now, and I think that this is now the third consecutive weekly close below its short-term moving average, which usually leads to a little bit more downside. Have we already seen enough? Not 100% sure. Here on Microsoft, clearly in a funnel, just like SPY, just like Q's, the QQQ, looking the exact same thing. Megaphone, head and shoulders pointing down. Volume's just not there yet. Goog, same thing. Pointing down, lower lows, lower highs. It's breaking down. Volume's not quite there, though. Amazon already made its big old nasty cut. It's still got 20 more bucks to lose to retest those lows, but it's looking really similar, too. Rejected at the 50 weekly. And then Tesla, right? The Lone Ranger. Oh, we're on a log scale here. Whoops, let's go to arithmetic. Wow, that's why Tesla looks a little funky. It moved bigly. It moved big up since 2020. Big ups. Big ups for Tesla. Looking here, we have an inverse head and shoulders, but we also have a massive head and shoulders. So we're going to ignore the wider pattern, more time, more validation, more significance. But for now, we'll focus on the IHS. Tesla might be the leader of the market now. Why? It's setting up a bullish breakout pattern here. If it can keep going up, this will be the consecutive weekly close for Tesla above its 50 MA. Eked it out last week. Doing it again this week. You go, girl. You go. I think that's it. So thank you for watching. If you're interested in watching more, I encourage you to watch the video from January, which is our bear market of 2022 explained. If not, thank you so much for watching, and I look forward to seeing you on the next one. Thank you.